So you've been working hard for your money, but you want your money to start working hard for you. People tell you that you need to start investing, but if you're new to investing, there's all these terms that you've probably never heard of. Index funds, mutual funds, ETFs, S&P 500, limit orders. All this stuff can be very intimidating and scary, but it doesn't have to be this way. I'm Terrell Higgins, your real estate and personal finance nerd, and in today's video, I'm gonna be breaking down why you should be investing, what you should be investing in, where you can actually invest, when you should start investing, and how much you should invest. And I'm gonna be explaining it all in terms that anyone can understand. And at the end, I will do a live demonstration on how you can automate investments into a brokerage account to set yourself up for a sound financial future. And if all that sounds good to you, kick back, stay a while, and we will get into it. So if you've been saving your money, that's a great start. But by just putting your money under a mattress or in the cupboard or even in a bank account, the real spending power of your dollars is going down over time. A good example of this is if you look at a carton of eggs. So in 1980, a carton of eggs cost 84 cents. And in 2024, that same carton of eggs costs $3.37. That's 4 times more expensive. And this effect is called inflation. Historically, inflation is between 3 to 4%, but in recent years, it's spiked as high as 8%. So if your money isn't earning at least the same rate of inflation, the real spending power of your money is going to go down over time. So if you look at the average savings rate on a savings account in the US right now, it's 0.46%. So if you had $1 million, that means in 1 year, that $1 million would give you $4,600. But if you were to invest your money in the S&P 500, and we'll talk about what that means and how to do that later, the S&P 500 returns 10% per year. And in 2024, it actually returned 25%. So your $1 million would have made $250,000.
What is he doing?
He's beginning to believe.
So how do you actually invest your money? There's really only 3 ways to do it: businesses, real estate, and the stock market. And I love discussing all 3 of these topics, but the easiest one to get into by far is the stock market. You could change your financial destiny today. Like in a couple minutes, you could set up a brokerage, automate contributions, automate where the money's going, and the outlook for the rest of your life will be changed. And it doesn't require any special skills, any special knowledge. It just takes taking the initiative to start.
Oh, I like that. Yeah, me too.
So for the rest of this video, we're going to be focused on investing in the stock market. So what is the stock market? The stock market is just a collection of businesses, and you can buy in to their future performance. By buying stock, you are buying a little piece of that company. And if they do well, you do well. If they make money, you make money. It's just that simple. You have a share of their future performance. And you'll often hear people discussing the S&P 500. So the S&P 500 is an index. So it is a collection of the 500 largest companies in the United States. So the companies that have the most money and have some of the best performance are captured in the S&P 500. And this S&P 500 index is what all other investments are measured against. When someone says they're beating the market, what they're talking about is the S&P 500. That's what they're comparing their investment to. And the S&P 500 has been a phenomenal investment for a very, very long time. So if you look at this graph from the 1980s to now, there's 14 different market events that have occurred since the 1980s to now. And the market went down and recovered. But if you ignored all the hype, if you ignored all the discussions about bull markets and bear markets and all that noise and just kept your money in the market and you put $10,000 in, you would be a millionaire right now. And since the inception of the S&P 500 in 1957, it has made 10.5% every single year. So if you just buy and hold and wait, you will make a killing. And there's a couple other indexes out there. So you might hear of the Dow Jones Industrial Average. So the Dow Jones is just a collection of 30 companies that are very large and are well established and are considered market leaders in their sector. So they're considered blue chip stocks or stocks that are so large that they have lower volatility and they control the sectors in which they are in. And then some other indexes that are worth noting are the NASDAQ and the NASDAQ 100. So the NASDAQ is a very tech-heavy index. So a lot of the market leaders in technology like Apple, Meta, Google, those companies have been driving the performance of the NASDAQ. So a lot of the tech growth that we've experienced in the last 10, 15 years, you can see in the NASDAQ. And the NASDAQ has actually been outperforming the S&P 500. And there are way more indexes out there than the three I mentioned, but you really don't need to invest in all these different indexes. Just buying the S&P and one other index that can outperform should give you all the returns you need for a rock solid investment plan. So another term that you might hear from time to time is market cap. And that's just a fancy way of saying how many shares does that company have on the stock market and what is the total value of those shares. So a large cap company has over $10 billion worth of shares, and a mid-cap company has between $2 to $10 billion worth of shares, and a small-cap company has less than $2 billion worth of shares. And these are large numbers, but there are trillions and trillions of dollars flowing through the stock market every single day. And historically, the large-cap companies don't return as much money as the small cap companies. And a lot of that logic's been turned on its head with Apple and Nvidia and Google and Meta. There's 7 companies that are called the Magnificent Seven that have actually been driving the returns of the overall stock market. So that logic has kind of fallen apart in the last several years. But generally, small cap has more potential for growth than the large cap companies. So what should you be investing in? So there's a couple ways to invest in the stock market. So the first one is to buy into individual stocks. You don't have any diversification. All your money is in a single company. And this has the highest potential to outperform the market and also the highest potential to underperform the market. People spend their entire careers trying to figure out how to do this well. And it is very, very difficult. I would not recommend doing this as a beginner. And honestly, I would never recommend doing this at any point in your financial journey. The second way to invest in the stock market is to buy a mutual fund. So what a mutual fund is, it's a collection of stocks for various companies that are managed and picked by a fund manager. So the fund manager comes up with an overall strategy for the mutual fund, and then you buy into that fund, and he makes all the purchase and buy decisions. He figures out how much he needs of each company to reach the overall objective of the fund. And in return, he takes a small fee of the money that you've invested with him to continue managing the fund. These mutual funds are focused on a single sector or a single index. So maybe it's focused on energy or biotech or technology. And these funds generally have a higher minimum buy-in than you'd see with a stock. So these funds can require thousands of dollars to actually buy in and invest, which makes them less attractive for beginning investors. And then there's the last way, and this is actually the most popular way to trade the market. It's called an electronic trading fund, an ETF. So an electronic trading fund is a collection of stocks, just like a mutual fund would be, but there's no fund manager in place. So it doesn't require the same maintenance fees, so you're paying less money to get those returns, and the minimum buy-in is much, much lower. And having lower fees means more money actually goes into your pocket. But it also means that there's a wider variety of trading ideas and indexes and products out there for ETFs than mutual funds. So the best ETFs to actually buy into are index fund ETFs. So like the S&P 500 and that NASDAQ and that Dow Jones Industrial Average, they're actually index funds that track the performance of those indexes. And if you buy these funds, you're going to get exactly what the performance of all those 500 companies or all those tech companies did across the previous year. So there are mutual fund versions of these index funds, but you really want to go with the ETF versions because of the lower expenses. So that's the overall philosophy behind investing, but how do you actually do it? So all of these different investments have something called a ticker symbol. And a ticker symbol, you can think about like the address. It's the address where your money is actually being sent to. So AAPL, that's the ticker symbol for Apple. NVDA, that's the ticker symbol for NVIDIA. SPY, that's a ticker symbol for an ETF that tracks the S&P 500. QQQ, that's the ticker symbol for an ETF that tracks the NASDAQ 100. All these different investments have a specific ticker symbol or address where you're going to send your money. So if you ever don't know what the ticker symbol is for what you're trying to invest in, you can just Google the ticker symbol for that trading idea or that company or index. And it will tell you what you need to type in to actually invest in that thing. So where should you be investing? So you have retirement accounts through your employer, and generally retirement accounts have some tax benefits associated with them. And depending on what country you are in, there's different names for these retirement accounts. For the United States, you have 401k, employer-sponsored plans, and individual retirement accounts, IRAs and Roth IRAs. In the UK, you have the SIP or pension, and then you have individual savings accounts. In Canada, you have registered retirement savings plans, RRSPs, and then tax-free savings accounts. And in Australia, you have superannuations. Let me know in the comments below if I said that right. And individual retirement accounts. So one thing that's worth mentioning with these retirement accounts is an employer match. So getting an employer match is probably the best deal you can ever get in the stock market. So if you made $100,000 a year and your employer had a 6% match, what that means that if you contribute 6% of your income, $6,000, then your employer will also contribute 6% of your income, an additional $6,000. So you've made 100% return on your money from day one. You cannot beat that return. So if your employer has some sort of matching contribution, you want to contribute up to that match. Even if you're still trying to pay off high interest credit card debt or other forms of debt, you cannot beat this 100% return, and you absolutely want to be taking advantage of that benefit. And generally, putting your money in a retirement account is going to give you some tax benefit. I'm not going to go into all the different countries, but for the United States, a 401k, a traditional 401k or traditional retirement account, that money comes out pre-tax. So if you're putting the money in pre-tax, you're trying to lower your taxes for right now. You're trying to lower your taxes for this tax year. And Roth accounts, Roth IRAs, Roth 401ks, that money comes out after taxes have been taken out of your salary. And you're trying to lower your taxes for the future. So any growth that occurs in a Roth is going to be completely tax-free. So as your money is growing in that account, when you hit retirement age, you can withdraw it and not pay taxes. Where in a traditional account, you didn't pay taxes up front, but when you withdraw it in retirement, you will have to pay taxes. So that's the difference between a traditional and a Roth. And I go into a lot more detail in some of my other content about what you should be investing in and at what point in your investing career you should consider switching over between these two types. But that's the overall philosophy with retirement accounts. So when should you start investing? So you ever watch your favorite sports team and it seems like they're sleepwalking through the entire game, and then they really have to turn it on in that fourth quarter to try and get back into the game and actually win? You don't want to do that with your finances. You want to be putting in the effort consistently for the duration of your life. The earlier you start, the harder your money is going to work for you. And investing time is the thing that does all the work. If you have time on your side, the amount of money you actually have to invest is very, very small. Which brings me to my next point. How much should you actually be saving in these accounts? So if you only have about $100 of extra money per year that you could be putting in to one of these accounts, you should probably be working on making your income more consistent and investing in your skills and yourself to generate more money. But once you get to that point where you have some additional cash flow in your budget, it's not going to take very much to get this outlier performance. So if you're 20 and you put $100 a month into a retirement account, by the time you're 65, you'll have over $1 million. And if you were 20 and your salary was around $30,000 a year and your employer was offering a 3% match and you decided, hey, I want to get that 3% match, that would be about $900 a year that you're contributing, and that'd be $900 a year that your employer is contributing. So $1,800 across the year. That works out to about $150 per month. And that doesn't sound like a lot of money, but if you did this, by the time you're 59, you are a millionaire. And if you waited to traditional retirement age of 65, you have over $2 million. The median salary in the United States is $42,000. So you don't need to earn a lot of money to get this outlier financial performance. You just need to be disciplined and consistent, and you'd be amazed at your results. So we'll be going through a live demonstration on how to invest your money using the Fidelity brokerage. And this demonstration, all of it was going to be done on the desktop version of Fidelity. And if you do it on a mobile phone, it's going to look a little different, but please stick with me. So the first thing you want to do is you want to go down to where it says link an external account. And it's going to pull up this screen, and you just got to type in whatever your bank is, whatever that primary account is, where your money comes into from your job. So whatever that account is, type it in and link it to your Fidelity account. And I'm not going to show that here because I've already linked my bank account to my Fidelity account. But that's step one, is linking your bank account and the Fidelity account together. Then once you have that done, if you want to automate this savings process and never have to think about it again, what you want to do is you don't actually want to click on trade. You actually want to click on transfer. So you click on transfer and you go down to where it says manage recurring transfers. So you click there, and then it gives you two types of transfers. So investment transfers, so where you're investing with the transferred money, or transfers where you're just putting money into the account. You want to do investment transfers. And then you click up here where it says create new activity, investment, and then this pops up. So it says security type, stocks, ETFs, that's what we want. You pick the account, then you put in the symbols for whatever you want to invest in. So in this particular case, I always advocate for the S&P 500. So I will show you that S&P 500. So VOO is the S&P 500 index fund ETF that I suggest. And VGT is the NASDAQ 100 ETF that I suggest. So we have these two selected. And then say we want to contribute $200 a month. So what we'll do is we want to do this every week, and we'll do $25 into each of these every single week. And you might think, well, I won't be able to buy an entire share of the ETF with $25, and that's perfectly fine. Fidelity actually lets you buy fractional shares of these ETFs. So you can contribute very small amounts, and it's perfectly acceptable. So every week you're going to buy in $25, and you might be thinking, well, why didn't we just select the monthly and do $100 at the end of the month? By buying in smaller chunks at more frequent intervals, you're taking advantage of this concept called dollar cost averaging. You're buying high, you're buying low, and if you buy in more frequently, you have a better chance of averaging out your returns and getting smoother, better results, as opposed to just buying in once per month. So whatever amount you want to contribute for the month, you want to break it down into weeks and figure it out that way. So $25 per week is about what I want to do for each of these investments. And then you can pick which day of the week. Always like to do Tuesday. There's no particular reason, but Tuesday is the day I select.
I'd gladly pay you Tuesday for a hamburger today.
And then you can pick the start date, which no better day than, the present. So then you link your bank account here and you hit preview, and it shows you what you're about to do. And once you hit confirm, you have automated your financial future. This is the only thing you will ever have to do, and it will keep buying into these investments forever and ever and ever until you stop it. You have automated the correct behavior for your finances, and you never have to go back in here and do anything ever again.
Yesterday, you said tomorrow, so just do it! Make your dreams come true! Just do it!
And if you've made it this far in my video, please like and subscribe to this channel. I put out helpful content like this every single week for people at all parts of their financial journey. And if you want a deeper understanding of why investing in low-cost ETF index funds is the best investment that you can do, I actually did an entire video on that exact topic. Thanks for tuning in, and I will catch you next time.